Hi, it's John with Vision Advisors, and welcome to another Insight with Vision. In this issue, we want to touch on an AXA study that was done in March of 2019, really focused on understanding the important role protection plays for consumers when it comes to growth and income in retirement. This study, again, was commissioned by AXA, and the survey itself was performed by the Insured Retirement Institute. Let's take a look at a few of the key findings of the study. First and foremost, we found in looking at the study that protection for consumers today is key. They are significantly concerned about protecting what they've spent a lifetime accumulating. In fact, if we look today at how many consumers across America are really diversifying and where they're putting their dollars to grow for retirement, here's something we found that's interesting. On average, most consumers in America today have about 50% of their assets in stocks, mutual funds, or ETFs. They're really focused on stock-based growth of their money. But as we look at lower risk investors, that number drops to only 37% having money in stock-based allocations. And for the ultra-conservative investor, that number drops to 25% of their total portfolio. Now, there's a couple of reasons why we see these particular numbers play out, and the first was the fear of losing money. Consumers are concerned about the fact that the market today is at all-time highs. Many of them still are remembering and still have some concerns over 2008, and they don't want to have all of their eggs in the basket again in the event we see another significant market correction. The other issue that I found was interesting in this study was the fact that for those getting closer to retirement, there was a lack of trust in the market itself as being able to sustain those retirement assets for what could be 20, 25, 30 years in retirement. And there was a significant concern about volatility. And as a result of that, less money was being directed into mutual funds, stocks, and ETFs, those stock type of allocations. Now, there's a problem with this approach. And first off is this. If they're under allocating to stocks, which according to all of the historical data we have, nothing has outperformed the stock market over time, even going back into the 1880s. You know, Jeremy Siegel's book, Stocks for the Long Haul, is probably the definitive guide to explain that. But if we don't have enough money in growth allocated assets, we hamper the long-term growth opportunity of our money. That means retirement goals may not be met, and that also means that not only will we not have enough money as we get ready to retirement to live on, there's going to be an adequate saving for financial risks, such as healthcare expenses, whether it's a heart attack, stroke, cancer, other acute issues that arise we can recover from, or those chronic ADL-based issues that result in a long-term care event that means we're going to be paying for care for many, many years to come. And then, of course, due to the fact that we're living longer, inflation is going to have more of an opportunity to really create havoc in someone's guaranteed income accounts as they're looking at how they're going to pay for things 10, 15, 20 years down the road as the cost of things continue to rise here in the United States. Now, there's some interesting consumer expectations as we found in this report as it relates to risk. Notice this first one. 58% of those surveyed believe that they are only somewhat or not very well prepared for a major health event. Now, that correlates to what we found earlier in terms of one of the fears that they have. If they're underinvested in growth type assets to create the dollars, not only for income, but to pay for expenses, 58% of folks are afraid they really haven't done that well. 73% of consumers that are either low risk or ultra conservative, they've got a lower exposure to the stocks or stock-based investments. They're much more concerned about running out of money because they're looking at nominal rates of return and realizing that over the long haul, that may not be enough. 80% of consumers, again, that have a low exposure to stock market-based or stock market-linked types of financial instruments are concerned about a stock market drop right before they retire because many of them are reliving 2008. And they saw their 401k become a 201k. And now that they've made all the money back and are starting to make money again, they don't want to go back and repeat that process again. But here's one that's interesting. 92% of consumers expect inflation to have an impact on their retirement, with 26% of those either extremely concerned are very concerned about the prospects of inflation devouring the purchasing power of their dollar over time. Now, when we look at the fear of loss versus the risk of running short of money in retirement, some interesting numbers played out. Those that are concerned about losing principal. Interestingly enough, 83% of those surveyed said that not losing principal was either extremely important or very important. The fear of running out of money was a major concern to 73% of consumers. They were concerned that the income they had would not last throughout retirement. Interestingly enough, another 66% said they preferred investments with a certainty of return, even if it was lower, as long as there was some certainty that they were going to get something or that they weren't going to lose anything. They were more comfortable with some return than a hope that they could hit the home run every year but have to experience the market losses. Out of those that were uncomfortable with how their assets had been allocated, 59% of those were not comfortable with their asset allocation, especially the ultra-conservative investors. Those that had a lower amount of money in the market, they were uncomfortable with the amount they had, but because of their fear of loss, they didn't want to increase those numbers. But interestingly enough, 55% believed that an investment risk is necessary to achieve financial success, meaning they felt like they had to have money in a market-linked or a market-based strategy to be able to have a better chance for success. So what's the key takeaway from this particular study? Let me give you a quote from the article that said this: 79% of consumers are interested in learning about a product or a strategy that offers principal protection and the potential for growth. So as I look at that, I think principal protection plus the opportunity for growth, what are we really talking about? We're talking about an annuity, either a multi-year guarantee annuity where a client can purchase a product similar to a bank CD that's going to give them a fixed rate of return for anywhere from 1 to 10 years, and that's going to be locked in, or an opportunity for a fixed indexed annuity that gives them a chance to have market-linked returns and market-linked growth where they're going to share in a percentage of the upside, but not have to deal with the downside risks that are associated with a direct investment in the market. So as I went back and I evaluated and I looked at all of the concerns that clients had that were voiced in the particular article that we're referencing today, I noticed we could really check off all the boxes using an annuity strategy. They don't want to lose principal. Bang, I can check the box off because MYGAs and fixed indexed annuities give us the opportunity to have principal protection. Clients don't lose money in annuities. They're concerned that income won't last throughout retirement. Well, guess what? An annuity is one of only 3 financial instruments, the other 2 being Social Security and a pension, that give us lifetime income guaranteed that we never outlive. They prefer lower certain returns to higher uncertain returns. MYGAs fulfill the opportunity for us to be able to bring about those certain returns. And if the clients are looking for a higher opportunity, but again have the downside protection, a fixed index annuity fits the bill. They're not comfortable with their current stock market allocation, but they're afraid of taking on more risk. Again, a fixed indexed annuity can give them a market-linked return where they share in a portion of the upside without having to have that downside market exposure. And then lastly, those that believe that investment risk is necessary for financial success, but they're concerned about losing money in the market, a fixed indexed annuity gives them an option to participate more fully in having some of their monies linked to a market-based return, but not directly invested in the market where they have all of the exposure that's there. So there's some very unique opportunity, and really a unique opportunity for you to have a conversation with your clients to let them see that even though they want to take risk off the table, they can still enjoy all of the benefits that they're looking for in having market-linked returns. As the market goes up, if they're using a fixed indexed annuity, they have an opportunity to participate. If the market goes down, zero becomes their hero because in a fixed indexed annuity, they have a floor of 0. And some fixed indexed annuities today have a guarantee as high as 1.6% on worst case scenario. So we can really take that risk off the table. But as you're having client conversations, which I hope this will spark you to do and give you some insight into the fears that the consumers you're dealing with there, understand this. At Vision Advisors, we know and understand principal protected planning. We can help you have that conversation, identify product and solutions and strategies that can help you address these concerns that your clients have. Give us a call at Vision Advisors if you want to learn more, 1-800-505-8489, or visit us on our website, visionadvisorsinc.com. This is John Terry with Vision Advisors. Thanks for joining us for this Insight with Vision.